Imagine you're building a house. Day after day, you're stacking bricks, putting all your energy and time into something you hope will last a lifetime. After years of hard work, you stand proudly in front of your creation. But then you spot small cracks in the foundation, tiny mistakes made early on that now threaten the stability of everything you've built. Suddenly, those little errors become very, very expensive. That's exactly what happens with investing, especially if you're using ETFs to grow your wealth. ETFs are often described as simple, safe, and transparent. And for the most part, that's true. They are an amazing tool for building long-term wealth. But here's the catch. Even with ETFs, there are subtle traps that can eat away at your returns for years, sometimes without you even realizing it. In this video, I'm going to walk you through the 10 most expensive ETF mistakes that investors make. These are the slip-ups that can quietly sabotage your portfolio. But don't worry, we're not going to get lost in technical jargon. I'll explain each one in plain English with real-world examples so you'll know exactly how to avoid them. By the end, you'll be ready to invest smarter and let your money truly work for you. So grab a coffee, settle in, and let's dive in. Mistake number 1. Waiting too long to start. It sounds simple, but the biggest mistake of all is not getting started. So many people spend years in research mode. They read endless articles, watch hours of videos, and try to find the absolute perfect time to enter the market. While they're stuck analyzing, time is slipping away. And here's the truth, time is your greatest asset in investing. Thanks to the magic of compound interest, even small contributions can grow into huge sums if you give them enough time. Let's look at the numbers. Suppose you invest $300 a month with an average annual return of 7%. Mistake number 2, constantly changing your strategy. Picture this. You finally commit to a strategy, maybe buying a global ETF like the MSCI World. You're feeling confident until you open the news. Tech stocks are overvalued. China is the new growth engine. Suddenly, doubts creep in. Should you ditch global investing and load up on China? Here's the problem. Constantly switching strategies is expensive. Markets are noisy and move in cycles. If you're always chasing the latest headline, you'll end up buying high and selling low, the exact opposite of what you should do. Take the AI boom. Many investors reshaped their portfolios to pour everything into AI stocks. But after every boom comes a correction, and those who switched late often paid dearly. Thoughtful, long-term adjustments are fine. Emotional reactions to headlines. That's a recipe for underperformance. Choose a strategy you believe in and stick with it. Mistake 3. Switching ETFs for tiny cost differences. One of the reasons ETFs are so popular is their low cost. An ETF that once costs 0.22% a year might now be available for just 0.15%. At first glance, that seems like a no-brainer. But here's the trap. Selling an ETF often means realizing gains, which triggers taxes. Plus, you risk losing money if the market moves against you while you're switching. The difference between 0.22% and 0.15% is tiny. You'll likely lose more in taxes and transaction costs than you'll ever save in fees. Stay loyal to your solid ETF unless the savings are truly significant. Mistake for paying high brokerage and account fees. A lot of investors bleed money not from bad ETFs, but from unnecessary fees. Imagine you invest $300 a month, but your broker charges a 1.5% fee on every trade. That's $4.50 a month. Over 30 years, those small fees can add up to over $5,000 lost. Money that should have been compounding for you ends up in your broker's pocket. And the worst part, these costs are completely avoidable. Today, there are plenty of brokers offering free ETF savings plans and trades for less than $1. In investing, every percentage point matters. Mistake 5. Falling for thematic ETFs. This one is sneaky because it plays on your emotions. You see an ETF for renewable energy or AI or gaming. These themes sound exciting and full of potential. And yes, sometimes they perform spectacularly ... for a while. But here's the reality. Thematic ETFs are bets, not broad investments. They get popular when the hype is already at its peak. By the time you invest, it's often too late. Hype is not a strategy. Build your core with diversified global ETFs first. Then, with a small slice of your money, you can play around with themes you're passionate about. Mistake 6. Believing in active ETFs. For most people, ETFs mean passive investing, but the finance industry started slapping the ETF label on active products too. An active ETF has a team of experts trying to pick winning stocks. Sounds great, but study after study shows that most managers fail to beat the market consistently. On top of that, active ETFs usually come with higher costs. Just because ETF is in the name doesn't mean it's passive or cheap. Always check if an ETF is tracking an index or if someone is making active bets behind the scenes. Mistake number 7. Investing in ETFs you don't understand. This is a golden rule. Never put money into something you don't understand. Take covered call ETFs. They promise extra income, which sounds like free money, right? But these strategies only work well in certain market conditions. When markets get volatile, those extra gains can evaporate. If you can't explain how your ETF works to a friend in 1 minute, it's too complicated for your core portfolio. Stick with what you can explain in plain English. Mistake 8. Overcomplicating your portfolio with overlapping ETFs. A common myth is, the more ETFs I own, the more diversified I am. Not always true. Someone might own an MSCI World ETF and an S&P 500 ETF, but the S&P 500 makes up over 60% of the MSCI World. They're basically holding the same stocks twice: Apple, Microsoft, Amazon, just with different labels. Simplicity beats complexity. One global ETF already gives you thousands of companies. Only add extras if they genuinely diversify your holdings. Mistake 9. Paying for currency hedging. You don't need currency fluctuations scare a lot of investors. People rush to buy currency hedged ETFs, but here's why that's usually a waste of money. First, hedging costs extra in fees. Second, global companies like Apple earn revenue in many currencies, so you're already diversified. And third, currencies swing both ways and tend to even out over decades. Skip the hedged products and save yourself the cost. And finally, mistake number 10, stressing over dividend versus accumulating ETFs. This debate never ends. Should you choose distributing ETFs that pay out dividends or accumulating ones that reinvest them? The truth is, there's no wrong choice. Distributing ETFs give you cash flow, which can be motivating. Accumulating ETFs reinvest dividends automatically, creating a powerful compounding effect. The difference is marginal compared to the big picture, investing consistently, keeping costs low, and staying the course. Pick the type that matches your personality and goals. So, there you have it, the 10 most expensive ETF mistakes. If you take away just one idea, let it be this. The greatest risk isn't picking the wrong ETF fit, never starting in the first place. ETFs are a powerful tool. Avoid unnecessary fees, don't chase headlines, keep it simple, and focus on the long game. You don't need perfection, you just need consistency. Wealth building is a marathon, not a sprint. Each contribution is a step forward, and one day you'll look back and realize avoiding these mistakes gave you the freedom to live life on your own terms. Thanks for watching. If you found this helpful, please give it a thumbs up and subscribe for more videos on smart investing. See you next time.